Hey, testing, 1, 2, 3, testing, 1, 2, 3. The Wayne in Spain falls mainly on the plains. The ants in France stay mainly in your bonds. Let me know. You got sound? Hello? Hey, Michael. What's up, Mikey? Buckner. Buckarama. Well, hey, welcome to Trade Non-Farm Payrolls. Hey, Henley. Trade Non-Farm Payrolls live number 133. That's the 133rd month in a row that we've done this event at FX Street. It's pretty amazing, huh? Over 11 years. I remember starting this webinar, it seemed like just 11 years ago. So, hey, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne McDonell. I am the Chief FX Market Strategist for TradersWay.com. How are you doing? Namaste. Please visit TradersWay.com, open a demo account, test out our execution speed, test out our customer service, give them a call, check out our back office, download our MT4, check out our fees and our rates and our spreads. Very, very competitive. Give us a shot, huh? Oh, and of course you can hang with me every single day. That's cool too, right? So how you guys doing? Loving FX Street today? I remember I relied on FX Street when I started trading a bajillion years ago. A bajillion. Let's see. I don't think my chat's updating. There we go. Yeah, so great, cool. And I think the chat is updating on the webcast as well, huh? Yeah, cool. So, yeah. So what do we got going on? We got non-farm payrolls. Guess what? I think it's going to be on trend. Why would I think something like that? Well, you think about it. For those who are new here, questions are encouraged. You're the boss. I am a humble currency analyst and trader with many years of experience. I'm here to share. I can talk technicals. I can talk fundamentals. I can talk trader psychology. We could scalp, spot, swing, position trade. We could talk about managing portfolios. We can talk about anything you want. So the agenda today is obviously focused on the news. Non-farm payrolls comes out in an hour. We're going to look at headline. We're going to look at revision. We're going to look at unemployment rate. We're going to look at hourly rate. Okay. On top of that, I believe there's trade balance. There may be some Canadian news. No ISM services today. That's going to be on Monday. Everything's delayed because of the holiday. So anyways, that's sort of the agenda. But once we kind of get past all the news and the excitement, we have at least an hour that I just can do Q&A. We could talk about all kinds of things. So keep that in mind, okay? So the first half, it's going to be dominated by the news, and the second half, it's going to be dominated by you, if you're okay with that. Does that sound fair? Where's my FX Streeters? Now, I believe, some people are going to be on YouTube as well, but that'll be transferred over. Cool. If you are watching on YouTube, hopefully they provide you a link to the live chat so you can chat there, because I can't see YouTube chat. Good coffee today. You notice how much my head has shrunk? Yeah, my head shrunk. Oh, wait. No, I have a big cup of coffee. All right. So charts are all right. Everything's good. Fine. So do we need to talk about the fundamental side? I mean, hopefully you've gone to fxstreet.com and read the article on how to create a model so that you can estimate non-farm payrolls headline number, right? Hey, Joe, first time in a long time for NFP. Cool. So anyways, you should already know that. I'm assuming you know how to build a model. And you know, it's silly to rely on other people. That's why you need to know how to model and do that kind of analysis, not just technical analysis. And so if you ever wondered how they came up with 185,000, you can create a complicated model or semi-complicated model. I don't think mine's complicated, but it's detailed. You got to look at things like the subcomponent to ISM services, right? So now you're taking ISM and breaking it down into subcomponents, and then you're looking at that and the long-term trend and the recent trend and all that kind of stuff and extrapolate. Do you know how they come up with 185,000? Like, let's say you're an analyst at a bank, you're making $2 an hour, the trader is making $20,000 an hour. How do they come up with the 185? Usually they look at the 6-month average and the 12-month average. Like, whoa, stop me with your complicated math. Woo! Add up the last 6 NFPs and divide by, 6. Wow, really? Hey, Pete. So I can't see if this window here is updating. Maybe it's not, huh? I think every time I click yeah, it's going to update. Too bad. So sad. If that doesn't update, maybe I'll put something else there. So anyways, let's talk about where we are employment-wise in the United States. How has the weekly trend in the employment numbers looked? The weekly unemployment numbers. Good, bad, ugly, same old, same old. How would you describe the current trend in weekly jobless claims? Well, how's sound for you guys? YouTube apparently sound is low. Yeah. So is it me? So maybe you should give them the link to the better room. Let me check here. Properties. I don't want to mess with it too much. Hang on. Hang on, Bubba. Don't cry for me. Argentina. The truth is, oh my. Is that better? Oh my. That's funny. People on YouTube want me to speak up. Really? You think that's how it works? Really? I should yell at the microphone. Yell at the microphone, Wayne. All right. That's got to be better. All right. How's that to my YouTube brothers and sisters? Yes. See, look, you're the boss. You ask, I deliver. All right, cool. Even Dre's happy. Look at that. Even Dre's happy. Dre's never happy. Now Dre's happy. Dre's got it. Yeah. Right? Just had to ask the doctor, right, Dre? Cool. So anyways, you couldn't hear me, but we were talking about weekly jobless claims. And it seems to me weekly jobless claims have been kind of on average, right? So I don't expect a dramatic surprise based on that analysis. Okay, now ADP was ripper good, right? Right? We had a really good ADP yesterday. All right, cool. So that leans to the upside number, right? So you could say, I wouldn't yell at you if you said, well, the market's expecting $1.85, so if we hit the 200. So you says, hey, Wayne, did you say the 185K is an average of 6-month basis? I don't know, is it? But if you look at the 12 and 6-month average, I bet you it's very close. What I'm suggesting is, the analysts that you rely on in the media are, they're not that sophisticated. I don't think, not all of them, but I think what you're looking at is basically the 6 or 12-month average. And that's that. That's the number. I think you should do your own modeling because the way you make money in Forex, especially if you're a professional manager, is that you have your own opinion. You've done your own analysis. You have your own models. And you say, well, $1.85 for NFP headline expectation ain't bad, but if you use a more sophisticated model, you might say, well, I'm leaning at 200. Okay? So instead of just looking at a 6-month average, what I tell you to do is look at the 6-month average. Okay, great. Also look at this, let's say 6-month average on weekly jobless claims, which is different. See, the NFP number, the Employment Situation Report, is the household survey and the establishment survey. One is calling businesses and looking at payroll stubs. The other one is knocking on doors, talking to households and saying, hey, do you have a job? Do you have a job? Do you have a job? Okay? Then they use fuzzy logic mathematics. They put it into the sausage machine and crunch out a number, and it could be way off. And then they continue doing the survey, and a month later they have better data and release a better number, but it could be off by 100,000, right? I mean, statistically, it could be way off. And then weekly jobless claims are people that lost their job and are in need government assistance. So they're completely different numbers, so you want to look at both, especially if non-farm payrolls, what we call non-farm payrolls, the Employment Situation Report, since it uses so much math, a small sample size representing the entire United States, it can't be that accurate, right? So you should have more in your model than that. So then you could look at weekly jobless claims. You can look at the employment subcomponent to ISM services and manufacturing if you want to do that. Right? And then, of course, I also look at the Challenger report, as you see in the article. Oh, let's click on it. There he is. Pretty boy, pretty boy. Do that. Sorry for the high resolution. Hang on. Let me make that smaller. I forgot I was broadcasting in high resolution. Hopefully it gets crunched down okay on YouTube. So anyways, I go through the whole model here, okay, just as I talked, to give a couple of examples of how to scalp it, 2 different ways, give you some trading advice, go over some risks, and give you a trading tip. Okay, that's all on FX Street, okay? So hopefully you visit that and read that. So I'm assuming you read that, okay? So thank you for posting that. I appreciate it. So welcome to June, huh? So anyways, I think non-farm payrolls is going to be about as expected, maybe a little bit better. But remember, it's a total guess anyways, because you don't know what kind of weird math the analysts did. Also, you don't know the answers of their samples, right? Remember, the bigger the data set, the more accurate the data is likely to be. So their sample size isn't, I think, statistically that big. Okay? Sell in May and go away. Are you talking stock market? I don't know. I don't know about that. So anyways, so that's all. I think it's going to be about $1.85, maybe a little bit better, but it doesn't have to be, and then we can look at revisions. But there's something more important in the air. What is that? You know what? I got to change my chair. You tell me, what's a little bit more important? What's the bigger question? Stock market. Got this fancy chair. It's got 9,000 settings. Whoa! 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 There we go. It's like a first-class chair, right? Fed rate, well, it's not June. All right, so Peter says June Fed rate decision. No, that's already done. That's been bought. We already bought and paid for that. So what is it? Okay, Joe says wage growth and interest rate decision. Well, sort of. Okay, we'll look at wage growth that influences the interest rate decision. It's not and, it's because. Right? Do you remember your calculus? Right? Where it's a union or an intersection. So in this case, it's an intersection, I suppose, because you have wage growth and the interest rate decision, which are 2 different things, not one and the same. And wage growth influences, right, the interest rate decision, but doesn't create it. But anyways, June is done. It's bought and paid for. We ain't going back, right? So then what we have is SEP and DECE. And that's what we're really looking for, September or December. Is it 3 more rate hikes or is it 2 more rate hikes? And that's the money. That's the money, honey. Okay? And if it turns out that there's only 2 more hikes, June and DECE, then the dollar's going to get weak. Okay? That's all. Okay? So, wage growth, the unemployment rate, that kind of thing. See, what if wages stay the same, but employment unemployment falls even more, where you drop to like 4.3 or something. But we're only growing at 2%. Stagflation, right? Well, not quite, but full employment and low growth? It's not really what people wanted, right? Yeah, Joe says Yellen needs to give a clear sign that she's going to raise rates 3 more times. Well, do you guys follow, right? Like Powell, and there's a few that have been saying that, but I don't think he's a voting member right now. But you could, if you're a Fed watcher, you can really get into it and follow every personality on the FOMC, voting and non-voting. But they're kind of already saying that, some of them, right? But whatever. So we're going to look at the headline's going to be less important because nobody expects a surprise. Now, if the headline comes out 100, or it comes out 250, 260, all right, look, that's not expected, so that would be amazing, right? But that's not going to happen. So, assuming we're about $1.85, 200, that's already priced in, and it doesn't really change anything. If the unemployment rate falls, okay, that just gets us closer and closer to full employment. But that's not a good thing for the Fed. And I'm wondering if that even slows them down. And that takes a rate hike off the table, because you don't want to tighten and you have a labor market tightening, but there's no increase in growth and there's no increase in wages. You know what I mean? Like, I'd almost say lower unemployment rate would not be ideal. But what we really want to see is wage growth. So if wages go up, which is a subcomponent of all of this, then you're going to see the market move. That's going to signal 3. Okay? We got it? Now, if anyone comes in late, don't tell them. Say, where were you, bro? Marina's only looking at hourly. Yeah. All right. There you go. You want to go around the world? Around the world, around the world. Well, I guess I got to teach you how to scalp. You know what I don't have? A drawing tool. So, hang on. Don't have a drawing tool, so what am I going to do, Bubba? All right, hang on. Bear with me. Oh, where did that go? Hang on. I know you can't see, but I'm getting to it. Hang on, Bubba. Gee whiz. Hang on, hang on, hang on. Ugh. That's all on the other machine. I don't have a drawing tool. How do you draw with this platform? Well, let me turn the charts back on. We'll get through this. Let's figure it out. But we got to go to display capture. Okay. And bring it back. Okay. Oh, I see what it's doing. Strange. Trying to resize it now. Hang on. There we go. Sorry, I guess I have to do everything again. It's funny. We're almost done. Almost done. Hang on, man. Don't get upset. All right, so we should be good. All right. Okay, so I want to explain how to do this. So we're going to have to find an interesting way. Let's change this template to blank. All right, so this is what's going to happen when the news comes out, okay? The market's going to move one way or the other. We'll probably look at euro dollar, probably look at pound yen or something like that, okay? We're going to look at it on a 1 minute chart because we're going to do a scalp, a high volatility event-driven strategy. Meaning the event will come out, the market will respond, and will trade the vol. An example of that on a 1 minute chart, let's say the non-farm payrolls comes out and it's a bad number. Let's say the euro dollar jumps and you get a series of 2 or 3 1 minute candles that lead straight up like a rocket ship, okay? We have learned that the market, not us, right? We don't care about us. The market has interpreted the information as bullish for the euro dollar. And all that means to us is that on this high volatility event-driven strategy, we're going to be bulls. That's it. Okay? Do we buy high like this because it took off? You see a bunch of green candles. Do you buy it? No. So what we want to do is buy a retracement. Now, the most ideal retracement is somewhere between the 382 and 618 Fibonacci retracements, which is about here. Okay? And in this scenario, because we're bulls, all we want to do is wait. Now, since you're scalping, if you're using a 1 minute chart, it's probably going to happen pretty fast within the first 3 or 4 minutes. If you're using a 5 minute chart, it'll probably happen in a half an hour. Okay. You got it? And in that case, you want to consider buying. So if you're on a 1 minute chart, you want to see it come back into the sweet spot, and at which point it starts to turn north again. And you want to be long as soon as possible. As soon as you feel like we've hit the sweet spot and it's holding. Because if you do that, and let's say your stop is below this lowest low, right? So let's say your stop's here. Then you're risking the least amount. You might also say your stop would be, let's say, below the 786, or even below the sweet spot. It's your call. But if you're in here, right, then you're risking the least. So in a scalp, you want to be aggressive. If you believe this is support, as soon as you see green, you want to be long at support, because then your stop is close. If you waited to be up here and then entered, well, now your stop's still got to be down here or even lower, right? Oops. Right? Whether you enter long here or up here, your stop's still going to be in the same spot. You're just risking more. And you think you're being more conservative because you waited, but you're actually not being more conservative, not in a scalp. If you're going to lose, lose a little bit. And you're going to lose in scalping, so you might as well get a great entry versus a lazy entry, because you end up risking more, okay? Great. Now, a few minutes later, let's say 4 minutes later, price will probably be up here. You will be profitable. And you should be able to move your stop to break even within the first 3, 4, or 5 minutes. If not, if price is still whimpering around down here, your scalp has failed. I don't care if you're break even or losing 8 pips. It doesn't matter. If it's a high volatility event-driven strategy, then why are you not profitable within the first few minutes? If it's such high volatility going in your favor, how come you're not up 12 pips? If you're languishing in this zone, you don't have the volatility. Therefore, it's not a high vol trade, right? Do you understand? Now that's another additional risk. You're scalping. You're not really losing any money, but your scalp itself has failed. So when you're up here, and in particular here, approaching the double top. Oops, come on now. Come on, empty board. Come on. Okay. Now when you're up here, which would be probably minute 6 or minute 7 after, not the news, but after buying it off the sweet spot. Once you're close to this double top, I call this the line in the sand. This is when you need to move your stop to break even. You have no risk. Okay, so let's say that's your break even. The reason for that is that you're basically at a 50-50 chance. Now, I don't know if it's 50-50. Let's say it's 60-40, 70-30, 75-25, whatever. But at this point, it's sort of an event horizon, if you will. If it breaks, it takes off. If it doesn't break, like for some reason this is hardcore resistance, maybe it's a key pivot point, which we will pay attention to, okay? But let's just say for whatever reason, this pullback happened at significant resistance. We come up, we hit significant resistance again, and it holds. Well, you're going to get knocked out of break even. You had an opportunity to win. You risked very little money because your entry was good. And then at the moment of additional risk, you moved your stop to break even. So you had the opportunity. You removed the risk. you're a hero or zero. It came back, knocked you out, you lost nothing, but you had the opportunity, and that's a win. Yes, I know. It's a blank chart. I'm teaching you how to scalp non-farm payrolls when it comes out. I'm not talking specific candles at this point. Okay? This is just a strategic overview. So, this is kind of what we want, right, guys? An opportunity and reasonable risk, and then to remove the risk but still have the opportunity. Yeah. Okay? Right? And here's the thing. If it breaks, you're going to get paid, right? Boom. You're up here and you're going to get paid. If it drops, you not get knocked out. This is already a break even. You lose nothing. And that's what we're looking at a scalp. And that is discussed in the article. Okay? Now this says this was posted August 31st, 2015, but I think that's the date of the new FX Street website. I think I published that maybe 2014 on the old website. Okay? And nothing's changed, okay? And this is, let's see if it zooms in. Okay? This is what I'm talking about. Right here, news comes out, huge spike. In this case, a 382 Fibonacci retracement, and it takes off to the next level, wimps out, and you take profit. You get it? Expansion, retracement, expansion, profit. Okay? Now, if the news comes out in such a way that the market interprets a change in central banking policy, okay, where they're like, oh, wait, let's say it's bad, right? Let's say it's a really bad number, 90,000. The market says, hey, man, there's no way the Fed's going to raise 3 times, okay? That means there's a change in anticipated central banking policy. And I would expect that this takes off and doesn't come back and consolidate like this. It would jump, or in this case, yeah, it would jump, retrace, jump, retrace, jump, retrace, and probably head up to the no-fly zone to, you know, right, like 115. And then we'd have to look for a pullback, okay? Versus reasonably expected, it would take off, it would pop, retrace, right, and then stop at the top. Oops. Now, the other thing we can plan requires pre-planning. And it's a range trade, and I hope you can see this okay. Okay? Okay, in this case, this is where the news comes out. You see how it drop. So it's 2 minutes, 4 minutes, 6 minutes, 8 minutes, 10 minutes, okay? And it's dropped 50 pips in 10 minutes. That seems like a pretty normal NFP, right? Now, it used to be 300 minutes. This is a counter trend trade, so to speak. I mean, it doesn't really happen. It's a counter scalping trade, I guess you might want to call it. but you're trading the range. In a scenario like this, we want to identify key levels of support and resistance ahead of time. So let's say this is the weekly pivot target or a monthly pivot target, right? Weekly or monthly bearish pivot targets. This is where a bear is supposed to take profit and get out. And I'll show you pivots in a bit. This trade assumes that even though the news came out bearish, bears got what they wanted, the end of a trend. It was their target. It's where their take profit orders are sitting like a cluster. Just imagine thousands of TPs, right? Take profit orders are sitting there. Price comes down, hits all of that take profit. What does your broker do when you're bearish and you hit your take profit, or you just simply say, get out? You click a button and you say cash out, close the trade. How do you close a short position? How does a broker close your short position? You are not alone. I'll wait for the lag. I'm waiting. I'm patient, man. I'm a currency trader. I'm patient. All right, I'm running out of patience. There we go. There we go. No, you're already short, Michael. Hey, Mohit. Your broker gets you out of your short trade by offsetting it with a buy. Your buy cancels. Yes, Michael from YouTube says buy. Chima says buy. Israel says buy. Right, cool. Everyone says buy. Great. So you offshort a short position, right? Offset a short position with a long. Okay? So imagine less bears and more bulls. Herschel says, what's the relationship between non-farm payrolls and the stock market? It's not really that. Here's what you want to think about. It's not how non-farm payrolls impacts the central banking policy, and how does central banking policy affect the stock market, and that I'll leave you to figure out. Because here I could just tell you the correlation, and then you're just going to leave it at that, and then you'll say, well, Wayne always told me to do this. I'm like, no. It depends on what the central bank is going to do. Hang on. Hang on. Speaking to 1,000 people. Hit you back later, dog. So anyway, so you're offset, and all the bears are taken out of the market. We know that, so there's significantly less bears because of all those orders, right? And then if there are any bulls, or maybe bulls jump in because they see the change in direction, change of trend, then it can quickly go from bearish to bullish. Not necessarily because people are buying it, maybe because people are buying it, but more importantly because less people have sold it because they're no longer short. You see what I mean? So this type of trade now, we need to identify serious levels of support and resistance, and you may just trade it back the opposite way. It's your call, bro. Okay? I think if the number suggests a change in policy now, and this kind of answers Herschel's question again. Good NFP means what? Well, it depends, right? But in this case, if the number is interpreted that the Fed is only going to raise 2 times this year, not 3, they're taking a rate hike off the table, I would expect this to be less likely until it really goes way up or way down. Like we're talking monthly pivots here, okay? Big monthly pivot type stuff. R2, S2 kind of numbers, because it'll be a tsunami of fundamentals in that case where it's interpreted as a change in policy. It's not priced in. If it comes out reasonably okay, then things are priced in. So people would say, oh, the Fed has to raise 3 times. All right, great. It'll move. But when we kind of get to more like weekly targets, depending on what they are, moderately important pivot targets, moderately important support and resistance, not weak, but moderate, like, shorter time frame, that'll probably hold. So you get something like this, like you scalp it down for 50 pips, and then they take profit because that's a good trade, and then the others trade it back the other way. Bears will do what bears will do. Bulls will do what bulls will do. Now, if there's a change in perceived policy at the Fed, and it's extremely, let's say, bearish, extremely bearish for the dollar, which would be bullish for euro dollar, then it might just go up, 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 and not have a pullback like this until you're way up there. You got it? Now, I think LIBOR is more influenced by U.S. rates, not the other way around, but anyways. So those are the 2 options that we're going to look at today. What currency pair would you like to analyze? You know what? I'm going to take a quick break, like 1 minute. I'll come right back, and I'm going to look at the requested currency pairs that you want to do the analysis on. Be right back. All right, so we got Beast, USD Cat. Marina's like, Cat, this one. All right. This one's going to be a bit tricky. I wouldn't recommend CAD because I think we have Canadian trade balance or something coming out, which could monkey around with it. It's also very sensitive to oil, and oil might be doing its own thing right now, so I'd rather not do this one. Pound dollar, pound yen, lots of pound. Query says Euro USD now, sell or buy, please tell me short term. All right, pay me $1,000 and I'll let you know my opinion. Otherwise, do your own homework. I have an opinion, of course, but I'm not going to tell you what to do unless you pay me money. All right. Let's see, I'm trying to get my feet up. relaxed. All right, here we go. So, but we may do it anyways. We may do euro dollar anyways. But a lot of people want to do beast or pound. I have pound Swissy here. Let's just change that to pig dog. I'm okay with that. Cool. So what do we need for the counter trade? The range trade. What do we need to do first? Yeah, Marina says, okay, with the challenge would be nice, but, I don't know if it's a good challenge or not. I'm not saying it's not tradable, but, to do a webinar is not as easy, right? One news event is enough, is challenging enough. Two news events, you could have something that's good for the dollar, good for the CAD dollar, and nothing happens, or less happens, right? So what's the first thing we're going to need in this trade, guys? Identify support and resistance. Well, you can see right now, we're already in a cluster of weekly, monthly, central. Okay, it's not amazing. I see a cluster here, which is okay. That's an okay area. And then, of course, the extreme is up in here today. Okay. Downside, let's take a look, maybe 4 hour. Give it a click in. Well, first of all, before I click in, this. If we headed down there, there's a lot of interesting things going on down there. Let's click in one. And I'm thinking this area here. Okay. So let's investigate further. Okay. We have a mini range going on here, which I would expect one way or the other will break. We don't know which one, the way that it goes. I believe the counter trend, or at least where to anticipate a problem in a range trade where you would expect key levels of support and resistance, is going to be down in here. Okay. Another way of saying this is if you were short up in here, that's where you're going to take profit. Okay. And I'm thinking, this whole area up here, this is definitely resistance and that's resistance, but this is the monthly 131, 130.50. I mean, it's supposed to be really this whole area, really. And I'm going to expand this just a little bit to include that, okay? That whole area. Okay? It's this area here, so 130.50 kind of thing. But look at this at 131. I mean, wow. But that means we'd have to go from here, and that's less likely. So, this is an interesting area for show. And then even higher up, just as interesting, right? Way up here, but you'd have to get a crazy number. So let's say it is a crazy number. The Fed is going to only raise interest rates, June and Dece. Then that means up, all the way to 131, in which you should take profit and then look to sell to the downside. You got it? You see? Cool, right? Meanwhile, that's just the range trade. Mohit, I think you should be trading what you normally trade, first of all, and what you have a clear bias for. So you should be an expert enough to know if pound is going the wrong way, you should know it. Okay? And you should be ready for it. You should already know your support resistance lines. All right? None of this should be a shock to you. Okay? Because remember, I think as a professional, you should go into every trade already having assumptions. I never look for trades. You have to understand that. I never open my charts and go, oh, I wonder if I should sell this. Oh, I wonder if I should buy this. I already know what I want to do. I just don't know if I have the price. I'll say things like, is this the right price to sell pound dollar? Is this the right time to sell the pound dollar? But I don't look at my charts to say, should I sell the pound dollar? Okay? Now, I want to go in a little further here on the smaller time frames. Okay? This cluster here between the monthly and the weekly is a huge salzone, as they say in Italy. And Mikey, where do you want to sell the pound of dollar? Tony, you sell the pound of dollar at the salzone. I mean, right? So this is clear resistance. Well, it says building a trend following position. Yeah, but you wouldn't do it in a scalp. South African Reserve Bank, what's that indicator? I would say the South African Central Bank is influenced by the US dollar and by gold prices. I was checking into a hotel in Johannesburg, in Joburg. And the guy in front of me and his buddy, they were checking in. And the guy got, his bill or whatever. And the guy's like, Joe! And the other guy's laughing. He's just looking at his cell phone, barely paying attention. And he's like, it's only Rand. Don't worry about it. And at that time, the Rand was fairly strong. They just know it's going to be worthless one day. Like, dude, just spend it while you got it. Don't worry about it. It's only Rand. Throw it away. Don't complain. There you go. I learned a lot about the South African currency that day. Don't worry about it. All right, so we're going to get the news by tradethenews.com, and we'll get it faster than anybody else.
Expected 182,000, prior was 211,000. Unemployment expected to remain at 4.4%. Hourly earnings expected 0.2% for May. Month-to-month 2.6%. Year-over-year, weekly hours expected to remain at 34.4%. Labor force participation expected to remain at 62.9%. Let's get U.S. trade balance for April expected minus $46.1 billion. In Canada, April trade seen about flat. And labor productivity for the first quarter also due at expected 1.2%. Earlier this week, we got the May ADP employment change at much higher than expected, 253,000 versus the 180,000 expectation. And for the non-farm payroll data due out in a minute, expected at 182,000, unemployment expected 4.4%.
So thank you to FX Street for hosting. If you like what we're doing today, you can do this every day with me. Just open an account at tradersway.com. Even just a demo. Give us a shot, huh? Let us earn your loyalty and respect, okay? Tradersway.com.
The non-farm payroll unemployment data in just a few seconds.
Hey, don't blame me for mocking South Africa. That's not my problem.
Expected 4.3% for unemployment, 1/10 lower than expected, and a fresh cycle low back month payrolls revised lower as low as 174,000 from 211,000. Hourly earnings at 0.2% is in line with expectation. The back month revised down 1/10 to 0.2%. 2.5% year-over-year is 1/10 lower than expected. Weekly hours in line at 34.4. Participation rate dropping 0.2 to 62.7%. U.S. trade balance at minus 47.6 billion versus minus 47.1 billion expected. Prior revised wider to minus 45.3 billion. Canada trade at minus 0.4 billion. The flat expectation in April. Canada labor productivity 1.4% is 0.2 higher than expected. On the payroll data,
don't buy it at
resistance.
resistance.
147,000 below the 175 expectation. The back month revised down 21,000 to 173,000 total. Manufacturing payrolls dropping at minus 1,000 versus plus 5,000 expected. The back month was revised higher to 11,000 from 6,000. And on the non-farm payrolls, more than 40,000 short of expectations at 138,000, with the back month revised lower significantly to 174,000, 211,000.
Also, you notice
we've seen the dollar come under pressure here on the missing payrolls as U.S. yields continuing to push lower. The benchmark 10-year yield now testing, or briefly tested, the April low. And the euro now 112.48, so strength in the dollar. Weakness in the dollar and strength in U.S. bond markets. Gold futures catching a bit as well in a positive territory for gold on the weaker employment report, weaker than expected employment report. We did see the unemployment rate drop a tenth to 4.3%.
Okay, not much of a pullback. Remember, this is suggesting two things here. And let me turn the audio off now. It's suggesting two things. NFP was obviously disappointing as a headline number. But month over month average hourly earnings did not go up. And year over year, it was slightly disappointing, but certainly not going up. So generally not a good non-farm payrolls. And one may interpret this as one less rate hike. That's dollar weakness. Okay? And right now, this is the dollar right here. Okay? So we haven't even gotten a pullback yet. And you know, when I told you when they took, if they take a rate off the table, or the market expects that they took a rate hike off the table, there's going to be less of a pullback just because it's much more fundamentally important. Okay? But we still have a long ways to go here. So do what you got to do, boy. You know, be careful where all the support and resistance is, right? So let me try to grab this yellow. Okay? This is where you need to be patient and disciplined. If you're a bull and you're scalping, you need to wait for the proper price. It may go without you. Don't worry about it. You should be able to pick it up later. But don't jump in blindly because it's risk, right? So in this case, you just keep waiting for a pullback. Okay. What else were you supposed to do? Buy it on the way up to the weekly central? Right? Think about it that way. Like you're saying, oh, it's going up. You wish you were in it. Well, first of all, this candle happened so fast you're not in it. And then if you did buy it, you're right there at the weekly support or weekly resistance. That's how you want to run your trading career? Well, good luck with that, man. It doesn't show patience and it doesn't show discipline. Okay. So I think what it could do is go up to the next psych level. Let's say 129, and then it's going to pull back, and then you're going to be able to buy the sweet spot of that. Okay, so let's say something like this, and then you buy a pullback off of that. Okay? I think that's what I would do if I were me. Okay? Check this out. How to trade the MXN and why it works. There I am. You guys want to understand what I have going on here? By the way, we're short, right? These are the lines I drew yesterday, was it? So if you're a client of tradersway.com, we work together every single day, and this is some analysis we did yesterday to be short the USD Mexican peso. If you want to understand the logic of it, you can Google that, okay? How many people are going to hang out with me on Monday? At 7:30 in the morning, spend an hour together going through the market. On Mondays, I typically go through the calendar as well, prep for the week. We have new pivots on Mondays, so we do pivot strategy setups. Be nice to see you over there. It's always nice to see new faces. Okay, gold is taking off. Beautiful. Beauty. Okay. You can see risk off, huh? Yeah, Henley. Well, yeah, Henley and Daniel are there. Pete, they're there every day. Yeah, Henley and Oldface. So I'm looking at this US. Obviously, the dollar is weak, but I'm pretty sure the pound's going to be or the yen is going to be strong, and that's going to have to do with a little bit of a pullback there, guys. That's going to have to do with a bit of a risk-off attitude. So euro yen coming down. Let's change this to euro dollar. Okay. Here is a potential counter trend range trade. I'd rather be closer to 113, but 112 is where it could start. So this red zone is my predicted top for the week. So if you're a bull, you're supposed to take profits somewhere in that red zone. Okay? So I led a swing trading class a couple of months ago. One thing I taught is if you get down here early in the week, you either take profit on your short or you look for it to head back the other way. Only in a scenario like this. At the time, we didn't have the monthly central, so you can't say, oh, you should have bought it off the monthly central. We didn't have it, so that's after the fact. But, right, if anyone took the course, then they know that's the buy the other way. Either doesn't matter really. The fundamentals have changed, but we're just talking about technical targets here. This is where a bull is supposed to take profit. So, adding the high volatility event-driven strategy, which we talked about, to the range trade, which I showed you, even though this is taken off, and maybe it's given you a scalp or not, okay? And remember, we talked about it, if it was a rate hike coming off the table, there's less likely of a pullback. But now, when you let this run up into here, especially this 113 area, guys, this is where on a 1 minute chart or 5 minute chart, I would look for a counter move. Okay? So I'm not really chasing the scalp anymore. Okay? Because, let's put it this way. If I can draw this. Okay, it doesn't look good, but anyways. All right, better. I can live with that. All right? It's like, if it retraces now on a 1 minute chart, it's a lot less lovely. Because we've hit resistance and it's pulled back. But you still have, you have the right but not the obligation to buy this retracement. But you can. And then when it gets up here, I would definitely take profit, and I would definitely look for the counter trend back down and in a way. Okay? So when Plan 46 Beats says on YouTube, Wayne, will there be a pullback in euro dollar or euro yen, USD yen? The answer is yes. There's always a pullback. Always. Whether it fits your schedule or not, as far as timing, I don't know. Okay? So let's get to it. What am I saying? If you're a bull, you want it to retrace back into here. You notice how there's a pivot? There's even a pivot up here on the monthly side, probably less important. But ideally, you let this come down, and then you buy it up to this level, and your 113 is a target. You should get out at 113, and then look for a trade back down. I'm not saying it will. I'm just saying based on an increase in risk, this would be an ideal place to take profit. And then if so, something like this may happen. Okay? Oops. Okay? I'm not saying it will, I'm saying it might. Because up in here, you just don't buy. Oh, Peter said the USD Mexican peso did a 50% retracement drop for a good scalp like I had explained earlier on the blank chart. Cool. Doesn't always happen, right? Doesn't always happen, Peter, but it can, and that's why I say you should watch what you want to trade, because you can't watch everything, right? And you can't trade everything, so do it the other way around. Find something you're technically and fundamentally prepared for, and then see if it presents itself, the opportunity, right? So anyways, let me go back to this. A logical, intelligent trader that's done analysis, that's in control of their behavior, would tell you that 113 is not a place to buy. Doesn't matter if you have green candles, doesn't matter anything. It's just not the right place to buy. It just isn't. So if it goes there and then goes further, it goes higher, higher, and higher, and higher, it doesn't matter. If risk is important to you, and remember, if you're trading other people's money, risk is supreme. And at the end of the month, let's say at the end of June, and you say, look, I got 4% profits for you. Do they know if you traded non-farm payrolls or not? No. Do they even care? Not really. Now, if you lost 10% of their money, and you say, well, I got unlucky on non-farm payrolls because I bought it at resistance and it collapsed. Oh, yeah, they notice, right? So there's no need to be overly aggressive. If you're analyzing the charts properly, you say, well, even as a bull, I can't buy it here, so I'll need a retracement. And you have to have a career of buying low and selling high. If you don't do that, you're not patient, you're not disciplined, you're not in control, and you're probably not profitable. Okay? So you can say, well, I'm a bull, but I can't buy here. And that's the right language that I want to hear. And, even if you're a bull, let's say it does retrace as expected. What would a bull think would likely happen? Roll reversal off of this M4, and it would make a higher high. That's what a bull would think, right? Now, how many people were trading euro dollar with me a year or two ago? Because obviously I've been doing non-farm payrolls for over 11 years at FX Street. And if you've been trading euro dollar with me over the last couple of years, you'll know I have a nickname for the zone above us around 114, 115. Does anyone recall what that zone is? Hey, Avi. Barbecuing, huh? What you cooking, Avi? Fran says, interested that cable is falling to the yen. I think you mean pound falling to the yen. And if that's the case, yen is a risk-off move. Okay. Yearly R1. Well, that's not. Yeah, Peter's got it. It's the no-fly zone. I call it the ECB no-fly zone. Thank you. Yes, Hojo says no-fly. Right. Okay, good. So let's talk about that. Let's go to daily maybe. Okay. I had a theory a year or two ago that the ECB was trying to create inflation. Okay? That's what their monetary policy was all about, create inflation. There are two things that will kill inflation for the ECB. One is falling oil prices. Okay? And number two is an appreciating euro. Because if a euro buys more stuff, prices don't rise because because the euro buys a lot. If you needed to spend more euros to buy something, then prices are going up. You see what I mean? It has to do with purchasing power. In this case, an appreciation in euro purchasing power means you need less euros to buy things, which means low prices, which means low inflation, which is not what the ECB wants. Wow, I sounded like Obama there, for example. Did I sound like Obama? I thought I did. Wow, that's crazy. So anyways, I call this area up here the no-fly zone. If the euro gets up here, I'm wondering, I'm guessing, I'm speculating, I have no proof, no nothing, but the conspiracy theorist in me, which is not really much, I don't really have a conspiracy theorist, but I'm wondering, because you can see it fell hard here, then it fell hard here, then it spiked up and then fell hard, and then we tried again and fell hard. Again, fell extremely hard, and then up, fell hard again, right? Every time it hits this, it drops like a ton of bricks. I'm wondering if it's the ECB dumping euros. Whoop, whoop. So I wonder, okay, I wonder if there's a rollover up there that could happen. Probably not today, but if we get up there, I'm going to be interested. Wow, I can't even fit this in there. Guess we'll have to go that way. Stephen or Stefan says, the last non-farm payrolls, the dollar went opposite direction of the NFP figures. So you're saying the dollar went weak? The Fed with the NFP figures, so the Fed potential outcome had absolutely no impact on trading. No, it has to do with the number of hikes. See, you know, there's reality and then there's expectations. And it's when people adjust their expectations. So do you remember, I mean, it wasn't long ago that we were talking about euro dollar going to parity, right? Those people have been proven wrong. So now we're in this world where the central bank of the United States is tightening. It's right? And the central bank of Europe is relaxing. Complete, right? We call that central banking policy divergence. So there's a divergence between the two. So for a while that creates a weak euro and a stronger dollar. But then you get like an increase in asset prices because remember, everything that the United States did was to create an increase in asset prices. We got it. Housing prices are going up. Stock market is way up there, way up there. So if you had $1 billion and you're already heavily invested in the United States, now what do? Well, you want to look for value. Right? You could buy stocks in Vietnam, right? An emerging market. Or you could buy stocks in Italy or Portugal. Buy the CAC 40, right? So anyways, a lot of money is going into Europe now because people believe that the worst is over in the global financial crisis, that things will be improving. And if you have a 5 to 10 year outlook for your positions, I know you only have a 5-minute outlook for your positions, but if you had a 5 to 10 year outlook, you're going to say, well, I'm already heavily invested in the U.S. stock market. I've been buying it since 2009. All right, things are astronomically expensive now. Maybe I should be open-minded to Italian banks. I don't know. Italian insurance companies. I don't know. But the valuation proposition of a cheap euro and low stock prices say it's probably worthy to invest in. So that's what we're seeing now as far as flows. Okay. Do you remember? Do you remember when the euro was up here? Were you trading Forex back then in 2013? We're talking about this period in here. What was right? My salt and pepper hair. I have salt and pepper hair? Really? The euro was ripper strong. The European economy in 2013 was junk bond status and worse. I don't think, it was so bad you couldn't even call it junk bonds. Greek bonds were paying 20% interest or yield. Portugal on the verge of collapse. Ireland on the verge of collapse. Italy on the verge of collapse. Greece on the brink of collapse. France on strike and on holidays, smoking cigarettes and drinking wine. So nothing changed in France. And then, and what? And it was all Germany's fault. What? Why was it Germany's fault? Right? And by the way, the Germans didn't bail out everybody. The Dutch bailed out everybody. So anyways, why? What was going on in this period? Oops, that's too far back. How could the euro be strong? And we might even be, yeah, all of this. I mean, look at all this. 2007, 2008, 2009. I mean, it's all of these, right? What was going on in this time period? Why was the euro so strong? When is my next live event? Monday and Tuesday and Wednesday and Thursday and Friday of next week. If you go to tradersway.com and open a demo account, there is a link to attend my webinars. Hey, look what happened. Oh! Cool. So here's the thing, guys. Draghi said he'd do whatever it takes to protect the euro, which was implied as a guarantee against default on Greek bonds, Italian bonds, Spanish bonds, Irish bonds, so on and so forth. Do you remember the pigs? Portugal, Ireland, Italy, Greece, and Spain. So there was an implied guarantee on those bonds, and money flowed to Europe so that they can catch 20% interest rates on bonds. Can you imagine being your principal being backed by the ECB and you get paid 20% per year? So money just flowed to those countries. And the genius about this is then the ECB didn't have to spend any money to bail out all these countries. Genius, 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 right? Then what happened to yields a year later? Well, when you buy bonds, price rises, interest rates fall. Now, here's another way of thinking about it. Before the implied guarantee by the ECB, Greece said, please lend us money, please. Oh, by the way, we're about to default. There's like a 90% chance we're not going to have any money to pay you back. But please lend us money. So what happens to the price in bonds if you think they're worthless? Because the default because the potential of default is so high, it's practically guaranteed to default. It's like lending $1 million to a crack addict. Doesn't sound good, right? So the value of those bonds plummeted to near worthless status. Prices fall. So a crack addict could then say, all right, well, I'll pay you 20% interest on your loan to try to get someone to loan them money. It's like an auction, right? Well, will anyone lend me money for 10%? No. How about 11%? No. How about 12%? No. How about 13%? No. How about 18%? No. How about 20%? No. But they're trying to attract money, right? Like a magnet, the high interest rate. Well, the reason everyone said no is that there was potentially no probability of being paid back. You'd just be burning your money. So prices of those bonds fall. And as they fall, the interest rate to attract people to loan money to the Greek government or the Italian government or whatever, right, would have to go up. Then the ECB says, hey, wink, wink, nudge, nudge. I guess it's this way. Hey, wink, wink, nudge, nudge. I'll do whatever it takes. I'll do whatever it takes. Wink, wink, nudge, nudge. I lend the money. You see? So what happens is now suddenly you're like, oh, I can lend Greece money, and if they default, the ECB is going to back me up, and I'll get 20%. Boom! Here's $1 billion. Here's $1 billion. Here's $1 billion. Well, everyone now is buying Greek bonds, Italian bonds, Spanish bonds, Portuguese bonds, Irish bonds, right? So now bond prices go up, because everyone's buying, pushing prices up. And as prices go up, the amount of interest that they need to pay these people are falling, because you're like guaranteed, in interest rates now fall to 15%. You're like, I'm still happy with 15%, because the U.S. is paying 0.5%. So yeah, 15%, yeah, not a problem. 14, 13, 12, I'll still take it, more. Hey, we're only going to pay 7% on these bonds. Good enough, man. Boom, I'll take it. As long as it's guaranteed by the Fed, or guaranteed by the ECB, and the Fed's paying less than 0.5%, I'm happy with 7%. Here's $1 billion. Gee whiz, right? And it all normalized, and the ECB didn't have to spend a euro. Pretty cool, right? And then what happened when the market stabilized? A year later, those bonds rolled over, and an investor had to decide, leave the money in European bonds or cash out. So they bought a bond that paid 15 or 20%. And now when they renew, let's say Ireland goes back and says, all right, well, you can re-up, you can re-loan us money, but instead of 15%, we're going to pay you 2%. They're like, what? 2%? I'd rather buy the U.S. stock market. It's going up 10% a year. And that's exactly what happened. And it's logical, isn't it? That's what happened. Cool, right? And then what happened? The dollar got strong and the euro got weak. Why? Because everyone started pulling money out of Europe. The gold rush was over. And then all of a sudden everyone's like, let's buy Apple stock. Yeah, genius. How long have I been trading? 15 years. And before that, I was a venture capitalist. And before that, I was a high-tech entrepreneur. And after that, I was in kindergarten. Cool, huh? All right, we're not getting our bouncy bounce. We didn't get a bouncy bounce here at the weekly central. Little bit surprised about that. But this looks like, even though it didn't go far, this almost looks like the counter trade, doesn't it? Amazing that it only went to the first level of resistance and then collapsed, huh? This is the range trade as described in the article. Down. So these are 2-minute candles. So 2, 4, 6, 8, 10, and then you're buying it back 12 minutes after NFP. These are 5-minute candles, 5, 10, 15, 20. Cool. Now, if you're going to trade the other scalp, you can still look to buy it. So the new sweet spot on the 5-minute time frame is still here. Okay? And when you're scalping, you need to be prepared to take losses because you have very little analysis involved in this type of stuff. Okay? So you buy it here, your stop is here, and that's that. And you need to be prepared to take the risk. Now, you don't pull the trigger just because we're in the sweet spot, okay? You can use a moving average crossover, like a 5-8 cross up. You could use a bullish engulfing candle. It's a little quick, but you could do it. You could buy when the Stokes re-enters the trade zone, and that means a cross above the gray line on the bottom. Okay, like this. Okay, like this, like this. Okay, it's not the cross up, it's the cross in. Okay. So like this, if you bought it here, that's a false buy. And you don't know how to use an oscillator properly, okay? And God forbid you say something like, oh, well, the stochastics made me buy. Oh, ventriloquist, yeah. Probably make as much money, huh? Okay, so it's not the cross up that's important, it's the cross in. So decide what your trigger is going to be. Let's take a look at the dollar here. Okay, you might want to keep an eye on the dollar and look for it to kind of drop down. So couldn't you possibly do something like this? Wouldn't that be beautiful, huh? Yeah, but see, GM says euro stronger than pound. I'm only picking pound because you guys pick pound. Okay? I believe more money is flowing into Europe to buy European stocks. I don't think I'd buy the British stock market because there's still risk on Brexit, but I would love to buy some real estate. I was in London last year. Last year was a good travel year. I was in, let's see, Johannesburg, Paris, London, Shanghai, Shenzhen, Guangzhou. I can't remember if I went to Dubai. I don't think so. I think I went somewhere else as well. Can't remember. Great travel year. But I was in London on a beautiful day. Can you imagine a beautiful day in London? Oh my God, it was so beautiful. Gorgeous day. And you're walking around town. Brexit's just been discussed. I went to a nice cigar bar and I'm smoking a cigar. Struck up a conversation with someone who's obviously a wealthy gentleman. And we were talking about Brexit, and he said it was really bad for them and all that kind of stuff. And I tried to make a comment like we were talking about, tried to switch it over to investing. Like I said, oh, well, I'm a currency trader, so what do you think about the pound? And he looked at me and he's like, are you talking about money and finances? Oh my God, you know? To him, it was like talking about cleaning toilets. I'm like, well, this guy is a true English gentleman. Where like talking about money is beneath him. Like, money? Oh. poor because money is still important to me, you know. Is there a reason you chose to have the lower end of the fib on the euro US? I don't know. We did pound dollar, I believe. I'm not sure what we're talking about. I did switch over to euro, right? So let's go back to here. Okay. Gee whiz, gotta squeeze this in. So this is the 382 618. Sorry, 382 50% and 618. This is still a potential buy, guys. If you're bullish, that's a buy. It's a little dangerous because it's a slight lower low, but you know, on a 1 minute chart is less important. You can go to a 5 minute chart. So by the way, I'm going to do a scalping training course if you're interested. This is just new scalping. It's not my favorite way of scalping. There are much better ways of scalping than high volatility. Because in high volatility, I think there's a lot of emotion. But, you know, there's still logic. I mean, you can see it here on the 5 minute chart. It went up to the red zone. And I was pretty clear, wasn't I? That this red zone is where a bull would be likely to plan on getting out. Oh, but still. Peter's in the room now. Came over. So anyways, either way. Also, I draw my fibs upside down. Oh, no worries, Peter. What you probably threw you out is I drew fibs like this, and that probably means down to you, right? Would that be the case, Peter? I do something like this. Oops. That's not what I wanted either. I do this, and that means down, right? To you? Just by the way I drew it? What time frame do we have to wait for a pullback? On a scalp, 1 minute chart or a 5 minute chart. But in general with trading, whatever time frame you're using, and it depends. Okay? And it depends on the type of strategy. So if you were swing trading, I wouldn't recommend a 1 minute chart. You might use a 1 hour chart or a 4 hour chart. So it really depends. I like to use all time frames. So this is just a scan that I use. Okay? But a typical setup, like let's bring up euro dollar here. Okay? Here's my setup. That's funny. That didn't update. I have to look. This PC might not have the in there. All right. So anyways, I use this is supposed to be a 15-minute chart. This is supposed to be a 5-minute chart. This is supposed to be an hour. Yep. And this is supposed to be a 4 hour. So this is my typical setup. And you see all the screens behind me? This would be one screen. Okay. And so I'm using all these time frames. Whoa, 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 whoa. Okay. So anyways, that's what I'm looking at. That's how I typically trade. So what time frame's important? They're all important. So you can see yesterday, I was looking to play the short off the sort of the 1250 area with the assumption that the Fed will want to raise interest rates 3 times this year. And you can see the market has changed their opinion on that. Therefore, as will I. Now, things will probably adjust over the summer. It's not a big deal. But you notice, like I was showing you before, this is the logical place to stop buying. You understand? So regardless of this major news event, there were take profit orders in here. There were. That's it. It's not people selling. It was scalpers that scalped it up or took profit. Or it was these guys that bought yesterday here or Wednesday here, and they're taking profit now. Why? Because when they bought it, they put their order right there. They said, when you get to 112.72, get out. Could the pound dollar be pricing in the election uncertainty? Sure. Why wouldn't it be? Okay. According to monthly pivots, we're supposed to visit 114.69 to 115.45. I'm going to mark 115. Okay. That's where I want to get out. I think it could potentially keep working its way up, but I've already explained this to you, so I don't need to do it again. In that case, we're in the no-fly zone, and I'm going to want to dump it. So as far as I'm concerned, this can keep going up. Not this week. I don't think it's going to go farther than where we are now. It can go as high today as 113. And like I showed you before, I'd probably look to sell it here and then probably buy it at 112.50 on Monday morning. Okay? So basically I'm doing this now. Ooh, that's a reverse. Well, I guess if we went up there today, it'd be more like that. Yeah, so up to 113 maybe today. And then by the New York afternoon, trickle back down to 618 around 112.50. And then buy it up, heading up to 14 or 15. Maybe by the end of next week. That'd be a swing trade, wouldn't it? So I think it'll do this. It'll hesitate at 113.40. No, it looks like it's 114. It'll hesitate on 114. And then it'll head back up and we're going to test 115-ish. Maybe by the end of the week, next week, 7 days or 7 calendar days from now. What do you stink? Smell like a plan? Trust in my... Stock market's going to open soon. So anybody interested in taking a scalping course? We'd have to do like market open, like New York stock market open, London stock market open, Shanghai stock market open scalping, news events like this, event-driven strategy, oil and gold market open scalping. We'd have to talk about gap scalping on Mondays. I mean, there's a lot of different types of scalping. And more importantly, just your standard volatility scalping. Not this stuff. Just there's, I call there's hardcore scalping. And for that, there's a reasonable amount of analysis that's required. But anyways, that's going to come up soon. Oh, and by the way, clients of Traders Way will receive at least a 50% discount. All right, so give me a currency pair that you want covered. We've done some basic ones. Maybe we should do the yens. Maybe I should just do the yens anyways. Trust in my... You'd have to check fxbootcamp.com for that, GM. CAD yen. Okay. So notice this, first of all. Euro yen down, USD yen down, Aussie yen down, pound yen down, CAD yen down, Kiwi yen down. Now, first of all, Japanese yen is strong. Okay? That's a risk-off scenario. So the numbers out of the United States based, on global macroeconomic level, it was considered bad. Okay? And Japanese investors, let's say, have decided to take their money out of the United States and bring it back home to Japan. Now, for people that trade with me every day, this is not actually a surprising move at all. And we're going to get ready now for summer trading. And this is why I'm doing the scalping trading course, because I trade with different styles throughout the year based on seasonality. If you watched the video I did in the middle of December, I'd been selling Japanese yen, which means buying yen pairs, let's say since the election, okay, for at least a month. Actually more, but, for a couple of months, let's say. I was buying yen pairs. And the yen pairs had skyrocketed, and they were up hundreds and hundreds of pips. So I did an interview at FX Street. It was like the second week of December, maybe third. And I said, I've been buying all the yen pairs, but I'm preparing to get out of them all of them. And then I'm going to sell all the yen pairs. I'm preparing to get ready to sell all my yen pairs. And I'm going to do that till the third week of January, in which I believe there will be a rally in yen pairs, but it'll be a false rally. And then it will fall all the way to April, in which time I will likely stop buying yen pairs, or selling yen pairs, I should say, and then I don't know, prepare for another false rallying into the sort of the June meeting. Now, how does one talk about 6 months worth of trading in advance? And not just one way, like, oh, these yen pairs will be up for a while, and then they're going to fall for 3 or 4 weeks, then they'll rise for 2 or 3 weeks, but not make a higher high, and then fall for 6 or 7 weeks, and then probably have a bounce, but that'll be a false rally, and then it'll consolidate and move sideways through the summer. So now I'm actually talking about 9 months. Oh, thank you very much.
Hey, good morning, good afternoon, and good evening. But it's really how the Fed changes their tone and changes their dot plot and stuff like that you can get on the wrong side of the trade. And technicals will tell you that. Right? Technicals will tell you that. And so, I recommend people use monthly pivot points to really identify taxes. So the repatriation flows that particular year were fiscal year end, and then the Japanese fiscal year end. And so in April, I'm usually buying some Japanese, taking profit. Okay, and that's usually the first or second week of January. Right. Because it comes down to, if let's say you're an American and you're a hedge fund or some sort of institutional investor, and you've shorted all the yen pairs, so you're long all yen pairs right now. If you take profit today, you pay taxes in April of 2017. If you can just
see, I'm laying it out right there. You just heard, I'm long all the yen pairs, and now preparing to dump them all and sell all the yen pairs till the third or fourth week of January. So anyways, it's all there, bro. It's all there. So anyways, my point is there is seasonality. And the reason I'm doing a scalping course coming up is because I stopped swing trading, not completely swing trading, but I stopped position trading for sure in July and August because those are wealth-based investments. You can consider them almost investment strategies, not trading strategies, right? They're wealth-based, wealth-focused, that kind of thing. In the summer, we lose volume and volatility. The market conditions change. Now, losing traders tend to not change their strategy. They try to do what they did in February, and they apply that to the end of July, and they're like, hey, man, it ain't working. So then they change their indicators. They start using PSAR and ADX. And they're like, maybe PSAR and ADX will help. No, you're clueless. You have no idea about fundamentals. You have no idea why the market works. Technicals don't tell you any of this knowledge. Okay? So in that period, I focus on income-based trading, not wealth-based trading, income-based trading. Short-term, if you want to call it a scalp, call it a scalp. But they're short-term, hit and run, guerrilla warfare type stuff. In and out. Right? And that's a whole different thing. So that's why that's going down anyways. Because whatever's working for you today and yesterday and last week, in the next few weeks, you're going to find it's not going to work for you anymore. And you'll blame yourself. And you'll blame your indicators. And you'll blame a webinar you watched of mine. You're like, Wayne told me always do this. And, of course, you completely misunderstood. It's no one's to blame. You're just using the wrong strategy at the wrong time. Okay? Got to know where to hold 'em. Know when to follow. Yeah. So that's what that's all about. Summer school, Bubba. Summer school. So look at this. This is gorgeous. So what does this tell you guys? The yen is strong. We know that. Okay. And it will stay strong likely for the next few days, and then we'll likely start consolidating for the next few months. That's why you got to be income-based. But anyways, let's make sure they're all in the same time frame. Let's put these all on the hour. Apples to apples. Okay. Which one has fallen the most? We know there's congruency in the yen. The yen is the same on all of these because it's the same Japanese yen. So, right, we have a common denominator. Look at the numerators. Which one fell the most, in your humble opinion, relative to the others? And which one fell the least relative to others? Riddle me this. Anybody? Stock market's open, by the way. Ding, 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 ding. Did you lose sound or something on me? I guess there's such a lag I shouldn't ask questions. Okay, yeah, there is a lag. Wowzer. Maybe it's the chat. It's probably the video. You're getting my video 30 seconds late, probably. Okay. Moscow Gomez. Gomez, how did you get to Moscow? That's another town I want to visit soon. I had a chance to visit Moscow. I had dinner reservations at a very fancy restaurant, had a limousine parked out front, and I couldn't bribe the border guard at the airport. I was shocked. I'm like, what are you talking about? So anyways, I'm due to go back. So what we're doing, guys, is called a relative strength exercise. So let's say you said Kiwi fell the least. Then the New Zealand dollar is strong. Strongest. Or not New Zealand dollar relative to the yen is the strongest. Aussie also didn't fall that far at the moment anyways. You can see it's double bottoming, but like Kiwi yen hasn't even double bottomed. So I'd say New Zealand dollar is the strongest? Oh, well, Ramesh says Swissy yen fell the least. Why? Why is that? And why would you expect that? I mean, I would assume that. In fact, up here I have plus minus pound yen. Or sorry, plus minus Swissy yen. Why is it different than all these others? Why do I have a plus minus Swiss yen? That's the wrong currency pair, as you can see. Because they're both funding currencies. And what the yen is doing, the Swissy is likely to do the same. So one great currency pair you probably don't trade that often is pound Swissy. If you like the pound yen, you should like the pound Swissy. Okay? Beautiful counter trend trade. Wow, look at that with the double bottom 1, 2, 3. Oh my gourd. Look at that, guys. That's definitely a tradable trade. And the funny thing is, this is a tradable sell. And this is a tradable buy. You would have made money on Monday and flipped it the other way on Tuesday based on basic swing trading strategy. Wow. That's clean. So anyways, they're both funding currencies. So when the yen is weak, the Swissy is probably weak. When the yen is strong, the Swissy is probably strong. And it's just based on macroeconomics. Let's check out the euro. You are not alone. I am here with you. Is it getting better, or do you trade the same? Does it make it easier on you now? You have yourself to blame. Let's see if we can learn something here. Okay, let's give it a couple of clicks. Yeah, that's too much. Well, okay, a couple of clicks. Let's give it a click. All right. Talk to me, Goose. Euro dollar went up, hit the pivot, stopped. Euro yen or Euro Aussie did nothing. Right on, Chris. Chris says great coverage of scalping NFP. Very helpful for a good profit on gold. Chris, when gold fell, we did our analysis on gold about a month ago, and we said 12.17 would be the bottom for gold for May. Right? And boy, it's up 50, 60 bucks now. So anyways, guys, euro is stronger than dollar. Euro and Aussie are about the same. And even though euro is stronger than dollar, and euro is stronger than pound, and euro and Aussie are about the same, so now we know euro and Aussie are both strong, the yen is significantly stronger. Oh, that's supposed to be an hour. Okay? So dollar's weak. Euro and Aussie have, let's say, parity as far as strength. And yen is the strongest. So you want to be short USD yen, right? And you want to be long Aussie dollar and euro dollar. And pound is less than euro, so you know pound is less than Aussie, so therefore you want to be short pound yen. Okay? Now imagine you did this at a glance. That's why I have so many screens behind me. Well, then, you know, on the short term, then there's I don't know, you wouldn't call it a mispricing, but, you know. Let's go back to gold. Gold! I need to update this this profile anyway. So oil, where do I have XAU? Gold. I need to update all of these. So let's change the profile. Template, pivot cluster. Template, pivot cluster. Template, pivot cluster. Template, pivot cluster. Okay, looks ugly, right? This is supposed to be a 15-minute chart. This is supposed to be a 5-minute chart. This is supposed to be an hourly chart. This is supposed to be a 4-hour chart. Better, right? Okay. And you probably don't need US dollar on everything, so let's get rid of that. Let's get rid of that. And maybe you don't even need it on your scalping chart. Cool. And you don't need it one click here, you don't need one click there, and you don't need one click here. Good, right? Ist gut, ja! So let's take a look at gold here. So 1217 was the projected bottom last month. Okay. Now the interesting thing, so I had 1217, which is about here. Okay. We talked about that on the way down. Okay. Not after the fact, not when we were there, on the way down. And it actually started up here, where I think at this point, it was more like 1225. And then in here, we had to adjust. So why such accuracy? Like, why am I picking out particular prices weeks in advance, adjusting weeks in advance? What am I doing? What is the cusp of the analysis? I'll wait the 30-second delay. You're going to answer, but I'm going to continue. Back in April, this was the projected top for the month. We knew that at the beginning of April. Well, somewhere in the middle of April, okay, we hit our target. And we say to ourselves, that's where the bulls are going to take profit. It needs to fall. And it fell back down into here. Then in May, so I'm actually off a week here, but then in May, we got new monthly pivot points and we were bearish. Why were we bearish? Well, we had already blown through the moving averages and attacking the fair market value. So to remain bearish in this scenario was reasonable. And the new pivot suggested the bottom for the month of May now, since this is the beginning of the month of May, the bottom of the market in May will be 1217. 1,217. Not 20, not 25, not 10, not 1,200. And I think it went about $3 or $4 lower double bottom, and then took off all the way the other way. The key to this analysis was monthly pivot points. So if you don't know how to swing, you're going to need to take my swing trading course. And you're missing the big moves, bro. If you don't know how to do it, you're missing the big moves, bro. You're missing it, Bubba. So anyways, look at the step-ups now. Up, down to the central, up, down to the central, up. So what are you going to do next week? Would you buy it at the weekly central if you had the opportunity? Well, here's the low. Let's say it goes up to the red zone. High, low, okay? And then we got to close it high. So let's say then it peters down to the price where we're at now. So we need to add these three numbers. High, low, and close. You know what? I shouldn't do it this way. Sorry. So we're doing some guessing here, but I want you to get the logic. High for the week, low for the week, and we're going to assume it's going to head up here and then close today in here. Kind of where we are now. All right, so let's do this. Kick busted. Doom, doo, 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 doo. Calculator. Oh yeah, I forgot. Windows can't run my calculator. Amazing, right? Okay, so I'm going to have to use my phone calculator. So what we need to do, what is this, 1283. Well, hang on, delete, 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 clear, clear, clear. 1283 plus 1274. 1274 plus 1257. 1257 equals, divided by 3 equals $1,271.33. So now we got to take a new and the new central is 1,271.33333333. This is the new pivot point. If we get a high and a close of here, this is your new buy zone on Monday. Yeah, bro, we're talking Monday, yo. Problem is, what? Let's drop into a smaller time frame. The uno. 1271. Oh, snap. We're 20 cents off a monthly pivot point. Typically, M3 is not a support, but what are you going to do, huh? So that's going to be the weekly central, right? And a monthly pivot. It's not supposed to be support, but it'll probably act as support, which means an early rally and then probably an early collapse. If we get up here, I mean, here's what I'm thinking now. Wait, no, this has to go up now and then down and then up. So, and then the new central. I wonder if we're going to attack 1300 next week and then dump it. I don't know. You'll have to be there. So like I said, if you want to hang with me Monday, Tuesday, and Wednesday, Thursday, and Friday of next week, go to tradersway.com, open up a demo account, takes 30 seconds. And in your back office, there's a link to my daily webinars. That's it. Be there, be square. Right? I'll give you almost an hour and a half of my time every day. I just ask for your respect and your loyalty, and you show that by being a client. So it's 7:30 in the morning until about 8:45, that kind of thing. All right, so we are caught on gold R1. Let me ask you this. And again, it's going to take you forever to answer, but please answer it anyways. Do professional institutional investors use weekly pivot points? Or was this just a random walk, a random coincidence? And if you believe they are, it's enough to influence the market, then maybe you should be using them as well, right? I don't know much, but I know institutional investors use weekly pivot points. Michael uses them, that's all I care about. All right, so this is probably a good time for us to go into like Q&A. I'll let you throw down some questions and we'll go into oil while we wait. Oil came up, hit the weekly swing short zone, fell and hit our target. Now the funny thing is, down is not a problem. I don't see why it has to fall significantly further. I thought that this might even hold, this 48 area. But really ambivalent about it, right? Like, it's all the same. The key one, and I had it on an old version of the chart, the key buy zone this week was really down here at 46 if you were going to be a buyer of gold. And my logic for being a buyer of gold is simply that it doesn't have to fall any further. And there's a reasonable amount of, intelligence saying that oil could drift higher. Now, it may not be a long-term buy. I'm not saying it's going to go up significantly, but the beginning of a bottom is not falling further, right? So this whole area seems to be okay. Now, when we did our analysis, we didn't know where the pivots were as well. But this is an obvious, buy zone, okay? And if I bought it here between 46 and 47, I would hold it. My expectations would be 2 weeks, a 2-week hold, maybe 3, maybe 5, I don't know, right? But that would be a long-term hold. And again, that would be part of a swing idea. Okay? Monthly supports here. Oops. Monthly projected low, if we make a low, is $40 a barrel. That's hard to believe right now. But maybe with the poor macroeconomic data that we got today, maybe it's plausible. I'll have to look at that. Now, things like inventory data wouldn't suppose such a thing. But anyways, the projected monthly high for the month of June is between 54.36 and 56.26. So let's just say 54, 55, 56, somewhere in there. Which one is it? Well, it depends if you're a bull or a bear. Remember, they're not telling you what's going to happen. That's your analysis that's supposed to tell you what's happening. So if you're a bear and you're like, man, this is still going down, then great. Then that's the projected low. If you're a bear, that is the projected low. Now, hear me out. My logic was no reason for it to go that low, which may mean a floor. A floor is a buy. Now, it doesn't necessarily say it would go up, but it's a buy, and then, of course, jam your stop. So the swing that I would be most interested in the near term, today, tomorrow, next week kind of thing, would be to buy it at 46 and change, 47 maybe, and target 55, maybe 56. So we're talking about, as high as $10. So in one contract, we're talking about a $10,000 profit. Not bad, right? So that's what I'd be looking for. I wanted it to go a little bit lower, actually. If it was going to head down into here, I'd rather pick it up the bottom of that green zone. Okay? Not the top of the green zone, because yes, that's important weekly, but I still think it could do this today. Up, this is a sell, down into here, and then that's the buy. Okay? So maybe it's up to 48. We're at 47.77. Let's say 48 and then down to $46.33. Okay? Wouldn't that be great? Up to 48. So it's down at 47, right? So down to 47, up to 48, down to 46.5. So that's oil. All right, so I need another break. I need to reload my coffee, maybe eat a banana, an apple and banana. So for the next half an hour, I propose that I answer your questions. And if you don't have any questions, then I might as well just go on and do something else, right? So when I get back in maybe 2 minutes, I'd like to see some questions, okay? Right? Be back in 2 minutes. Let me reload my bad boy here. Oh my God! Oh, Peter says, when is the due date? There's no due date. It's just something that you should do. This comes from an old question, guys, if you don't know. So working with the Trader's Way people, we were talking about planning and thinking bigger, right? And I was asked by the client whether, what would I do with $1 billion? Because they had $1 billion to give me. They're like, well, why don't you tell me? What would you do with it? Well, I had an answer. So, question is, what would you do with $1 billion? And I asked that to Trader's Way clients, like if you're managing, and let's say obviously you Forex, but what else would you do? What does your analysis tell you? What's your 6 and 12 month outlook for the U.S. stock market? What's your 6 and 12 month outlook for oil and gold? What about emerging markets? What about exotic currencies? What about interest rates? What about bonds? What about, treasuries? What about, what kind of portfolio would you create? And I think it's a good exercise for you, just, when you put your fundamentals together. And then what I said is build that on a like a demo account or just on paper, like literally on paper. And start allocating what percentage of your portfolio should be, let's say, sovereign bonds. Which ones would you buy? What are those rates? How, right? And that kind of stuff. And put it together and then track yourself for the next 6 months to a year. How does your portfolio perform? All right, it says I use the USD yen 10-year, the 10-year note, the Dixie to determine risk on and risk off scenarios. I just use yen. Not even USD yen, just yens. Here's what I do for risk on, risk off. That's not a good one. Let's do... There you go. That tells me everything I need to know. Yes, okay. If you want webinars like I'm doing now on a daily basis, go to tradersway.com. Open up a live or demo account. In your back office, there's a link to my daily webinar. Okay? If you want to play, you got to open up an account. It could be a demo account. It takes 30 seconds. You're just like that. Then download MT4 and all that kind of stuff. Okay? Okay, Duke Nukem. Highlander 48357. Risk on, risk off examples of what turns risk on and risk off. The only thing that turns things on and off is macroeconomics. That's all it is. Where's the best return for the least amount of risk? Which means, let's say Japanese investors were buying the U.S. stock market, okay? Let's just say that's been the trade for the last 5 years. Now, why would the stock market go up in the United States? Because the Fed was printing money. I don't like to even say that. The Fed had a policy of monetary easing, which is designed to increase asset prices, which is the same as to jack the stock market up and the housing market. That's what it was for. So because of the Fed, the stock market went up. I call it a free money rally. Okay? When global macroeconomics dictates a change in that trend, that's risk. They take their money off the table. So if things are showing that there are maybe better places to put your money, or maybe that the stock market is not the best place to have the money, you cash out of the trade, the risky trade that provides a higher return, right? Remember, return is a function of risk. So to get a higher return, you take the higher risk. But as long as you're getting a return, it's probably worth the risk. But as soon as you're not so sure about getting the return, you take the risk, you take the money off the table, and you bring it home. In this case, Japan. But it's not just Japan, right? I said the yen is a funding currency. So you can borrow money from Japan, pay hardly any interest on it. It's practically free. So you take, let's say $1,000 US in your trading account. You can leverage it 100 to 1. So now you have $100,000 worth of dollars. But then you buy $100,000 worth of yen, which is what? 100,000, which is like 10 million yen. And then you convert that into New Zealand dollars, which now pays you 250% per month in interest relative to your initial $1,000. Plus the pips. Okay, so now you're long Kiwi yen, even though your account is dollars. You see what I'm saying? So, something happens and you're like, whoa, something bad is happening economically. You say, get me out of that trade, which means you sell Kiwi dollar and buy Japanese yen. And it's not that you're pro-yen, you're just anti-risk. Risk off, pulling the money off the table. And that's why I say it's a funding currency. So interest rates are low in Japan. What are the interest rates like in Switzerland? They're negative. Negative interest rates. They pay you to borrow it. What if the bank paid you money on your mortgage? They're like, oh, Mr. McDonell, we've had a change here in policy at the bank. You have $1 million mortgage. We've decided to pay you $1,000 a month. Thank you for being a client. I'm like, hey. Right? What? So, yeah, that's what it's like. All right. Noreen Patel says, when you hold positions longer term, like 2 or 3 weeks, on a currency pair or an oil, how do you hedge your position for risk management? I don't hedge. I use the stop loss. I'm a speculator, not a hedger. So at the bare minimum, I have a potential for a small loss, but the potential for a larger upside. Over the course of time, when I'm enjoying some floating profit, I will move my stop closer to break even or to break even. And then if I'm enjoying even further upside, I will move my stop again to lock in a small profit, worst case scenario, until I hit my profit target. But there's no reason for hedge because I don't actually want crude oil. Right? So there's no hedge in that scenario. Okay? It's a great question, but in this case, yeah, there's no need. If you're in a trade for 2 or 3 weeks. The reason you would hedge is if you're in oil 2 or 3 years. So you're in a contract with somebody to deliver, let's say, oil at $50 a barrel. What do you do if oil's at $55 a barrel? Well, what do you do if oil's at $45 a barrel? Okay? And in one of those scenarios, hedging might be appropriate. But for 2 or 3 weeks, the risk is managed by stop losses. Okay? Thomas Moore says income trading, scalping. What pair to focus on? Euro dollar high volume in London session, Kiwi yen and any such largest interest. You know, it depends really. What I'm looking for is hardcore support and resistance. So I never hedge my positions. Why would I, as a speculator, why would I hedge? You're just throwing away your profit. Right? So a speculator says, you know, let's say general. There's 2 ways to be a speculator. You believe the lowest price has been achieved relative to what's likely to happen in the short term. So you buy it. And then you take profit. And you take profit because you bought it at support, now we're at resistance. And now if you're bullish, then you could just say, well, the next time it falls to support, I'll buy it again, and it'll make another higher high, in which I will take profit. Or if you're truly a very short-term trader, you could buy it at support, take profit at resistance, sell at resistance, take profit at support, so on and so forth. That takes more work, and I think on the long run, because you're always going to be a little bit late getting in and out, I think it's more work and on the long run, less profit. But a hedge tells me you're long only or short only, and you're in longer than 2 or 3 weeks. So like if you thought you're at resistance and you're long and you thought it might come down, well, a speculator would just take profit. Why would you hedge? And also lots of people hedge when they're uncertain. But I'm certain, right? I'm certain as a trader. I've done my analysis technically and fundamentally. I'm certain. And if I'm wrong, I take a small loss. Small losses are okay. Okay? But if, like I said, so you would hedge if you're in positions for months, not weeks or days. Okay? So for example, when I'm in a trade, I mean, not always, but, you know, I shouldn't say always, but I have a general idea where I'm going to get out. And I definitely know where I'm going to get in. Now, there are times in the years, and this is why I say, you know, not always. There are times in the years where I have no take profit. Okay? So there are times, so I told you over the summer, you need to be income-based trading. September, October, November, December, I'm wealth-based trading. So I'm building portfolios, which is a complete different kit and caboodle. Okay? It's completely different. And in that scenario, I have no profit target. My profit target is a clock. It's not actually a clock, it's a calendar. Okay? I know what I'm going to do and approximately when I'm going to do it, and I know approximately when I'm going to stop doing it, and I know approximately when I'm going to do the opposite, and I know approximately how long that will be. So again, if you want to know more about seasonality, watch that interview. Watch this interview. I mean, I predict up and down and up and down. You know, I'm talking 6 months in advance. And I think I'm like, I think you'll be surprised how accurate I am. And I don't just make predictions, I just tell you how it works. Just watch it. And yes, that's me on the side of a volcano wearing a 3-piece wool suit. Yes, I know. And I was on my way to meet with the central bank, so you got to dress appropriately. So like as soon as that video was over, or that interview was over, I went and met with the local government and with the central bank. Cool. A valid reason for a short-term hedge. See, I don't get it. When you short-term hedge, you throw money away. Now, you throw it away for a reason, because you believe on the long run. But if you're not in the long run, why would you hedge? If you were worried about the position going against you, why wouldn't you just take profit? What are your thoughts on Euro Pound? Daily trend was topping out. NFP. Even though that's been the big trade, Juan Villegas, right? Even though that's been the big trade lately, traditionally I don't trade it. So, we got the Brexit thing going, and then we got fund flows to Europe based on it simply being cheap and long-term opinions changing. But it's, so I'll show you. Let me put it this way. I have Euro Pound as a plus minus. So I used to look at the Swissy yen. Okay. I used to look at the Swissy yen to say, okay, I want to buy the pound today. Am I going to sell the Swissy or the yen? Which one's weakest? And I would start with that. In similar fashion, traditionally, and I mean over the last 10, 15 years, if I decided I want to buy the US dollar today, I'd say, well, which one's weaker right now, euro or pound? And I'd say, oh, look, pound's weaker. So if I'm going to buy the dollar, I'm going to sell pound dollar. And that's that. That's why I'd look at it, plus or minus. I don't have it on any other chart. So I do things in a very sort of categorized way. Okay? I don't go looking for trades. I have trade plans built in before I even look. Because if you go looking for a trade, you're going to find something, but you'll do it and you have no idea why. It's sort of like shopping while you're hungry. You're going to buy some crappy food and you're going to eat it simply because you're hungry. Got a question here. Do gold and oil induce moves on CAD, NOK, odd, or is it the other way around? Well, gold and oil are priced in dollar, so it wouldn't be that, right? So gold and oil influence the CAD, the NOK, and the odd. Now, gold, for example, instantly impacts my brothers and sisters in South Africa. And if you've been to South Africa, you know that. Just like, wow, the rand is gold. The gold is rand. Gold used to impact the Aussie dollar very, very directly. But that's when its percentage of GDP was higher. Now what impacts Aussie dollar would be things like the price of iron ore, coal. And of course, you have to look at their balance of trade. Okay? Traditionally, they're a net exporter. More recently, they've been net importers, which is really bad for the Aussie. And now that data is improving. And what is it that they export? Well, the two primary exports of Australia are iron ore and coal. Okay, so anyway, sorry about that. Copper also, well, if you believe copper is a large percentage of the trade balance for Australia. Now, copper may seem like it is, but copper traditionally is used as a bellwether for risk on or risk off. So it's sort of like gold can be a bellwether for risk off. Copper is often a bellwether for risk on. Because if you're building an economy, let's say China suddenly is doing really well, what's going to happen? They're going to need more energy to fire up the factories. They're going to need more steel to build more factories and skyscrapers. Steel is made out of iron ore, coal. Shockingly, those are the major exports of Australia, right? And they're going to need more copper for things like wires and plumbing and other electronic needs. Okay? And you'll say, oh, Aussie dollar's going up, it must be copper. Well, maybe, but it's just demand for copper goes up when the economy is expanding. So it's more global macroeconomic than it is specifically Aussie. And if the macroeconomics are improving to increase demand for all commodities, then you could say, oh, look, copper predicts Aussie. But it's not copper, it's China. And what's China? Bringing Europe on board. We already got the United States in the game. So, you know, it's sort of, you could say it is, and you could probably say, look, copper goes up, Aussie goes up. Yeah, but it's more like the U.S. economy is doing well. Let's say the economy in Europe improves. Demand for goods in general improves, which means demand for manufacturing in China improves, which means demand for commodities like oil, like coal, like iron, like just steel in general, like copper goes up, and all those things are supplied to China from well, not oil, but supplied to China from Australia, a significant amount of them. So trade balance in Australia improves dramatically, which means there's also demand for Aussie dollar, which means Aussie dollar goes up, and you're like, see, it's copper. But Australia might have hardly any copper relative to the amounts of iron ore and coal they ship. Copper probably comes from Peru. And you'll say, oh, it's Aussie. Well, not really. But Aussie does go up when copper goes up. Right? But it's, the A to B isn't necessarily B to A. It's really A to B to C to B that makes that go up. So, Joe says about weird that China's growing, but the Aussie isn't. Look at trade balance. Okay? When you import more than you export, that ain't good for your currency. Because you're flooding the world with Aussie dollars. When the world is demanding Australian exports, like iron ore and coal, they need to pay for it, which means they need to buy Aussie dollars to buy the goods, which means demand for Aussie dollar goes up, which means the value of the Aussie dollar goes up, and so on and so forth. So watch your trade balance data. By the way, trade balance data came out for, was it Canada today or was it the US? I know CAD had some news, but pay attention. Healer says, how's the Fed shrinking the balance sheet going to affect the USD? Depends on how they do it. Depends on how fast they do it, so on and so forth. Okay? But it's the same as raising interest rates, isn't it? So if the Fed sells a bunch of bonds, the supply of bonds goes up, so what happens to the price? Price falls. When prices fall in bond market, interest rates rise. And, it's 10:30 on the nose. Woo. So thank you to FX Street for being wonderful hosts. Thank you for being here, especially if you stayed the whole 3 hours. That's really cool. Namaste. And I hope you visit tradersway.com and open up at least a demo account so we can work together every single day. Give us an opportunity to earn your loyalty and respect. That's all I'm asking for. Right? That's all I'm asking for. Just the opportunity to earn your loyalty and respect. And hopefully I've done that a little bit today. Enough for you to visit and open a demo account. I gave you 3 hours. Maybe you'll invest 30 seconds more. Just go to tradersway.com. So thank you to FX Street for hosting me now for, 11 and a half years? That's a long time. So, yeah. Hope to see you next month if I don't see you soon. Next month I'll have to do non-farm payrolls from Harvard since I will be living on campus this summer. So, you'll non-farm payrolls 134 will be live from Harvard University. Hope you don't mind. I'm taking you along. It'll probably have to be shorter because I'm not sure of what kind of room I'll be able to finagle. Oh, thank you for posting the link. And stay tuned. Like I said, I'm going to launch a training course for scalpers, and I'm likely to bundle a bunch of courses I've done in the past and just offer it at a super mega discount for those who are clients. I'm thinking like bundle them all for like 66% off or something like that. I don't know. So look for that in the future if you want more of me. So I'm going to summer school. Maybe you will too, huh? Anything else? Thank you, Daniel. Yeah. So peace on earth. May the pips be with you. May your profits be above average. I just want to see what happened over here. Did we even get our extension on Pig Dog? No. Just up, fizzled back. So the only thing that happened was the range trade. So if you did that, you got it. But that kind of sucks. It's such a tight range. Take care, everybody. Beep, beep.